I feel like every year I say it's an uncertain future, but this one is really strange. You get inflation numbers, then you get unemployment numbers that are strong. I still think we're going to have a recession, but maybe Jay Powell will pull off a soft landing. Boy, the markets sure think he will. In the USA and in Europe. Somebody explained to me why Europe is so strong in this environment. It's amazing. Okay, a light winter, but man, it's really hard to figure out if you're bearish, you're getting hurt by this market rallying. It's tough to figure out where to be.
It is. And, with Europe, obviously, we've been reporting on the energy crisis there. It's turning into maybe a financial issue because they're spending hundreds of billions to make sure they don't go down the proverbial economic drain, if you will. Let's focus on the U.S., though. And I guess, Chris, if let's say the base case is for a mild and fairly short recession, okay, let's just assume that's the base case. If we indeed get that, a technical multi-quarter recession, has the stock market already priced that in with the declines last year and the reduction in multiples?
Well, that's what the inflows would make you believe, Brian. I still don't buy it. I feel like this market is overpriced and outdone itself. It's overbought, but it keeps rallying. So there's money flowing into the USA continually. And look at these earnings reports in the first quarter. They were not really very good news, but that hasn't slowed the market down at all. So this is an environment for a PE expansion, so I don't get it. The earnings are going to come down. Anytime the Fed raises rates over 450 basis points in a short period of time, you're going to see more pain. And I think it's still coming. But then again, I'm stymied by this market because it rallies on a regular basis. So watch the unemployment numbers. That's going to constantly tell us something. Obviously, the Fed is very data dependent. And maybe, like I said, Jay Powell pulled off the miracle. We'll see.
In the 70s, we got a number of bear market rallies where the S&P rallied, 20, I think even sometimes 30 or 40% before continuing to decline. Do you feel like that's what this is, or not as severe as the 70s? Because you're clearly nervous about U.S. equities.
Our portfolio, Brian, you hit it on the head. Our portfolio is tilted defensive. So that's worked against us in the last, 7 months. But I would hope it's not a 73, 74 bear market. That was horrible. I would think that we would see at least a decline. I said at the start of the year, I thought the market could give up 20% during the year. Right now, that doesn't look plausible. And we've broken a lot of the technical trend lines. So just because the yield curve's inverted, it doesn't cause a recession. It has portended a recession. And that's why I think many people still think there'll be something. The Fed has to slow the economy to get a lid on inflation. But hey, inflation is lightening up so far.
But the stocks that have gotten bought this year, and we look at them all the time and we show them to our viewers, they were the ones that got destroyed last year. It's like the exact mirror image, the opposite of 2022. I don't understand who's doing the buying. Do you?
No, I don't. There's still a big retail influence. The day traders of the Robinhood era are still there, but they're often options and daily traded options. What I'm seeing, though, is a rotation of the active managers who are trying to buy value because they think a recession's coming. So they're trying to own stocks with a dividend and own something that's going to hold some value through this. And the technology stocks are the ones that are laying people off. So it's a difficult environment for people to invest and make money. It's a time when you got to pick your asset allocation and stick with it. And hopefully you have enough diversification to balance your portfolio. Bonds now have a yield, so that gives you an option to balance your portfolio, but you can't be all in stocks unless you've got a very long time horizon.
What do you see as the outlook for both infrastructure and private equity?
Well, Brian, on private equity, it's tough because they have not marked those portfolios down very much. You look at last year, bonds were down double digits, stocks are down double digit. Private equity was flat. Something's got to give. Either the market has to come up, which it's doing, and so they can justify the values, or we have to see some write-downs. And you're already seeing it in some of the mega funds who are going out to raise new money. they're having a tougher time. A lot of portfolios are at their maximum that they can take in private equity. Sure, there's new money in the Middle East and in Asia, but there's just not a huge flow of money going in. Yeah. And I think you're right. The EBITDA multiples, when you got higher interest rates, the cost of capital, you're going to expect slightly lower returns. But again, private equity is a 5 to 7 year investment horizon, so the environment can change. But on your point on infrastructure, Brian, you raised a great one, which is, I think, the infrastructure of the world is still crumbling. They didn't repair it much during the pandemic. And now we have a massive energy transition. I see that as a huge mega trend that is both a risk, but also an opportunity. And infrastructure is going to play a big part of that, not just in traditional renewable energies, but in energy distribution, power distribution, a lot of different areas that needs long-term patient capital. And that's exactly what we are, long-term and patient for a nice steady rate of return.